Before we dive in, nothing in this video is financial advice. This is education only. Please do your own research and consult a qualified professional before making any financial decisions. Now, imagine opening your banking app and seeing that your monthly mortgage payment just crept up again. Or maybe you're on the other side, watching your savings account finally paying you something meaningful. Either way, one decision in Frankfurt is behind both of those moments. The European Central Bank just raised its deposit rate to 2.25%, and in this episode we work out together exactly what that means for your mortgage, your savings account, and your bond portfolio. Let's start with the basics. The ECB deposit rate is what commercial banks earn parking overnight cash with the European Central Bank. When it rises, that flows through to every credit and savings product in the eurozone. Think of it as the floor every other interest rate in Europe is built on. The June 2026 hike was not a surprise to markets, but the trigger behind it was. An energy shock stemming from the Iran conflict sent fuel costs surging, pushing eurozone inflation back up to 3.2%, well above the ECB's 2% target. With energy prices fueling a fresh inflation wave, policymakers felt they had no choice but to tighten again. Cast your mind back a few years. The ECB held rates in negative territory to stimulate a sluggish eurozone economy. Savers were effectively penalized for holding cash. The tightening cycle that began in 2022 was one of the fastest in ECB history, and 2.25% marks a dramatically different environment for European investors. A higher rate is not universally good or bad. It depends on which side of the ledger you sit on. Owe money on a variable mortgage, payments rise, have cash in a deposit account, you earn more. Hold existing bonds or bond ETFs. Their market price falls. Let's take each one in turn. If your mortgage is on a variable or tracker rate linked to Euribor, you will feel this hike in your next rate reset. Euribor closely follows ECB policy, typically within weeks. The exact impact depends on your balance and loan term, but the direction is unambiguous. It goes up. If you are on a fixed rate, you are insulated until your fix expires, and the cost of fixing has itself risen too, since fixed rates are priced off longer-term bond yields. Here is the genuinely good news for cautious investors. Higher ECB rates mean banks must compete harder for your deposits, and that competition is already showing up in savings rates across Europe. If your money has been sitting in a current account earning close to nothing, now is one of the better moments in over a decade to shop around. A standard savings account, an EU money market fund tracking the ECB rate, or a short-term bond ETF are all worth comparing. Real returns after inflation remain thin, but positive rates beat the negative territory of recent memory. Now for the part that trips up many new investors, bonds. The single most important thing to understand is that price and yield move in opposite directions. When central bank rates rise, new bonds are issued at higher yields, making existing bonds with lower fixed coupons less attractive, so their market price falls. If you hold a bond ETF, you will see this as a negative return in the short term, even though the underlying bonds are not defaulting. European investors typically access this through UCITS, ETFs, which follow the same price versus yield mechanics regardless of the fund's regulatory wrapper. Not all bond ETFs are equally sensitive to rate changes. Duration is the key metric. Roughly how many years it takes for a bond's cash flows to repay your investment. A short duration fund of 1 to 3 years sees only a small price dip when rates rise. A long duration government bond fund can see substantial swings. If you are in a long duration fund right now, this hike has almost certainly nudged your portfolio value downward, at least on paper. Here is a sobering reality check. Even at 2.25%, Eurozone inflation is running at 3.2%, so cash in a savings account is still losing purchasing power in real terms. Rates would need to rise further, or inflation would need to fall for savers to see a genuinely positive real return. That's exactly why the July meeting matters so much. All eyes now turn to July 23rd, when the ECB Governing Council meets again. Markets widely expect a hold at 2.25%. Enough of a consensus that a surprise move would likely cause real volatility. For investors, hold means the current rate environment likely persists through summer, giving you time to position thoughtfully. Briefly, the tail scenarios. If energy prices spike again, the ECB could hike beyond 2.25%, more mortgage pain and further downward pressure on bond prices, especially long-duration holdings. On the other side, if inflation drops sharply, the ECB could pivot to cuts later this year, bringing mortgage relief and letting bond prices recover, potentially delivering capital gains. Markets tend to price in cuts before they happen, so bond ETFs often move before the official announcement. So, what does this mean in practice? First, your emergency fund and short-term cash reserves, worth understanding, is that a zero-interest current account and a euro savings account or money market fund now sit in the same low-risk tier, yet pay very differently. Knowing that gap exists and comparing what's on offer is useful information regardless of what you decide to do with it. For your bond allocation, the key factor is duration. With rates elevated and the next move uncertain, shorter duration bond funds carry less price downside if rates climb further, while longer duration bonds carry more rate risk today, but could see larger price gains if the ECB cuts within 12 to 18 months. Which of those trade-offs fits your own portfolio depends entirely on your time horizon and risk tolerance, not something a general video can decide for you. Higher rates do not affect all equities equally. Sectors with high debt loads, REITs, leveraged industrials, some utilities, tend to face more pressure, while banks often benefit from a steeper yield curve and wider margins. Growth stocks, whose valuations lean heavily on discounting future earnings, also tend to compress. If you hold a broad European index fund, these effects largely cancel out, but they matter if you hold individual stocks or sector ETFs. Worth stepping back for context. The June hike wasn't driven by an overheating consumer economy. It was driven by an external energy shock linked to geopolitical tensions. That distinction matters. If the shock is temporary and energy prices stabilize, inflation could retreat quickly and the ECB may hold or even cut sooner than expected. If the conflict escalates, a second energy shock becomes a real risk. This is a macro environment that rewards staying informed and avoiding overreaction. Here's a simple checklist. Mortgage. Check your next rate reset date. Cash. Compare savings rates across banks, since loyalty rarely pays in a rising rate environment. Bonds. Look up the duration of any bond ETF you hold. Equities. Scan your portfolio for high debt, rate-sensitive sectors. None of this requires drastic action, but awareness is the first step. Going forward, 3 things are worth tracking: eurozone inflation prints, especially energy's contribution, geopolitical developments affecting oil and gas prices, and the ECB's own communication, since Christine Lagarde's press conference language often signals the next move more than the rate decision itself. Phrases like data dependent suggest no firm commitment, while any hint of a peak could be a positive catalyst for bondholders. Zoom out. Every rate hiking cycle in modern history has eventually ended, followed by stability and then cuts. We don't know exactly when this cycle peaks, but patient, diversified investors who position thoughtfully have historically been rewarded when the tide turns, while those who panic sell at the height of a cycle are often the ones who miss the recovery. Don't let rate announcement noise trigger a portfolio rebuild every time Frankfurt holds a press conference. Let's bring it together. The ECB raised its deposit rate to 2.25% in June 2026, responding to 3.2% inflation driven by an energy shock. Variable mortgage holders face higher payments. Savers and new bond buyers benefit from improved yields. Existing bond prices dipped, especially in longer duration funds. And the next ECB decision on July 23rd is widely expected to be a hold. If you found this useful, hit like and subscribe to the European Investor so you never miss an episode. And the best next step is our free newsletter linked in the description. Every week, we break down European market moves, ECB decisions, and portfolio ideas in plain English, so you always know what is happening and why it matters for your money. Remember, this is education, not financial advice. Always do your own research. I am the European Investor. Stay calm, stay diversified, and I will see you in the next episode.